Good morning, everyone. My name is Dan Gimbel, and I'm a principal and senior consultant with NEPC. I'd like to welcome the clients and guests of both NEPC and our good friends from Pimco. The reason we are all here today is to discuss inflation dynamics and the market outlook. We find ourselves in some very interesting times. Inflation has now reared its head after a 40-year hiatus, and the markets are reacting to the change and uncertainty that surround us. Today's event is a collaboration between NEPC and Pimco, and we thank them for joining us today. We'll have some prepared comments by both of our speakers, and then we'll open it up for questions from all of you. To submit a question, please use the text box near the top of your screen. I'd now like to introduce my colleague, Phil Nelson. Phil is a partner, and amongst many other things, heads the asset allocation team at NEPC. He's been with the company for 11 years and is responsible for the firm's macroeconomic views, dynamic asset class views, and our capital market assumptions. And now I'd like to turn it over to John Harari from Pimco. John?
Thank you, Dan. It's a pleasure to be with our friends and partners from NEPC today. Thank you to the audience for dialing in. My name is John Harari. I am a member of the client-facing team here at Pimco, focusing on our non-profit clients, including endowments, foundations, family offices, and healthcare institutions. I am here today with my colleague, Crescenzi, Vice President in the New York office. He is a generalist portfolio manager, a regular on CNBC, a prolific writer with a great eye for macro, who today will share our views alongside Phil on what we expect over the next 12 months and how we look at macro and inflation more broadly. So why don't I hand it over to Tony now to share his views, and then he will hand it over to Phil for the views on the NEPC side, and we can have a lively discussion. Thank you.
Thanks very much, John. Just a quick mic check. You can hear me, right?
Loud and clear.
Okay, good. All right, so let's go. And thank you all for joining us, and thanks to everyone for giving us this opportunity to share our views. Let me cut to the chase in terms of numbers, dispense with those. I have about 10 minutes to give a view of the macroeconomic and investment outlook from Pimco's perspective. So on the numbers, in terms of GDP, Pimco's projecting numbers to reach what could be called a soft landing for GDP, call it in the high ones for the end of this year, Q4 over Q4. A similar reading for next year, so no recession in the forecast, even though we think the odds of recession become elevated, call it 18 to 24 months from now. By elevated, it's around 30% is where we put the numbers, but they're just numbers. It's just higher than what the normal 18 to 24 month range would be. But a figure of the high ones is something the Federal Reserve and the financial markets would be quite pleased with. It would be characterized as a soft landing. It could be characterized as well as a so-called growth recession. So what's a growth recession? A growth recession is where growth declines. The growth rate declines, but it's not an outright recession. An outright recession, of course, is where employment and output decrease. We're not projecting that. We're expecting a growth recession where the characteristics are similar in that labor demand slows but doesn't turn negative, output slows but doesn't turn negative. And what's so wrong with that? The investor would likely say from that perspective, because it probably will mean a reduction in inflation pressures. There are lots of imbalances in the economy now that are causing the inflation pressure. Some of them relate to the amounts of disbursements that were made by the government during the pandemic, other facets related to the pandemic that have hit the supply chain, and of course, the rise in the price of energy. But if there were a slowdown, it would probably alleviate some key pressures. So for example, today you see news on the retail sector that doesn't look so good. That's not a great thing, of course, but there has been an imbalance there. There's been an excess of demand for physical goods over, let's say, services, because for a while, we all couldn't engage in the sorts of services we wish to, let's say go to a concert or to travel. And so we were buying physical items that wound up clogged in the global supply chain. Now you see the composition of spending shifting from goods to services, and that's affecting the retail sector. So a silver lining to the bad news on retail is that it does seem that there's a change in the composition and the aggregate spending that's occurring. Second imbalance that may help alleviate strains in the financial markets related to inflation is in the housing market. We're still sanguine about housing, and we have investments in non-agency mortgages, for example, yielding swap rates, which are close to treasury rates, plus 200 basis points. We'd like as well, we're favoring a bit more exposure to agency mortgage-backed securities. So we favor the housing sector. We think it's got very good fundamentals over the medium to long term. But in the short run, there has been an excess of demand. As you've heard, there are many stories about homes being sold very quickly and at prices well above the offering price. To the extent that there's some slowing in housing, and it's evident lately in existing and new home sales, which have fallen to 2-year lows. It's evident in mortgage applications, which have also fallen a great deal. If housing slows, a major component of the CPI, the Consumer Price Index, will see moderation. The housing component is about 40% of that index, and so it's important that that has happened. And finally, there's some evidence, although it's only on the edges, of slowing in labor demand. There's a monthly manufacturing index called the ISM index. The employment component fell into territory that suggests a reduction in employment in that sector last month, although tiny. No one wants to see unemployment rise, but what we do want to see is, and we meaning market participants, is a moderation in the amount of labor demand, because according to job openings, which are at 11.4 million, they seem to be well in excess of the amount of people available to work, given that the numbers of unemployed is 6.5 million. So there wouldn't be anything all that wrong, so to speak, with a slowdown in labor demand that would help bring the job opening figure closer to the numbers of people available, although we wouldn't expect it to go that far. And so the silver lining to some recent news is that the inflation dynamic might be improving somewhat based on some cyclical forces. Thinking longer term, and by the way, the Pimco forecast for inflation is for the CPI to fall into mid-4s by the end of this year from a little over 6% currently, and to the high 2s or so, call it 2.6, 2.7% by the end of next year. How it gets there is important. Phil may speak to this, but for now, it looks like the Federal Reserve might be able to achieve this with the policy rate somewhere around 3% or so. And so the prognosis looks relatively good in the next couple of years. Thinking out longer term, let's say a 5-year or beyond outlook, there are some forces that may keep the inflation rate a little higher this decade compared to last. In fact, last decade is probably the wrong analog for this decade. There's several reasons. One is something we identified in our recent secular forum, which takes a look at the 5-year horizon. We believe in this idea of resilience. Companies, nations, households will all take actions to try to become more resilient. On the government level, that means more spending on defense. And the key words there is more spending. And that's especially the case in Europe. For households, also trying to shore up their balance sheets. And for corporations, trying to ensure that the supply chain problems don't happen to them again. And they'll be looking at their supply chains through a national security lens, something they haven't had to do before. But now, with the risk of disruption, you may see them looking to do more so-called nearshoring or friendshoring, procuring items, commodities, etc., from friendly countries to allies of the U.S., for example. And so that may bolster inflation pressures potentially, because those efforts all might come at the expense of efficiency and lead to somewhat higher costs. So might the energy transition. If fewer dollars and yen and euros are spent on the so-called brown sources of energy and are replaced by green energy sources, then it's likely that the brown energy sources, the prices of those would be higher than otherwise, because it seems it's going to be capital discipline that limits the supply of brown energy sources, because nations, given that national security lens I mentioned, will want to get away from them. And that could mean higher prices in the interim, even if the long-term story is quite favorable for both energy prices and in terms of the costs to consumers, and of course the climate. And so, so we've got a story that's a little different. And the final note on that, and then I'll wrap up, is that we see in this decade some increased wage pressure. I mentioned the job opening figure relative to the numbers of unemployed. It looks like a situation that won't be alleviated all that easily. Of course, a recession would fix it quick. No one wants that. But thinking medium to long term, it looks like the prognosis is that labor shortages will persist. Why? Because there are lots of people retiring, for one, so the growth in the amount of labor supply will likely be meager. In fact, for some time, according to the Congressional Budget Office, the annualized increase in labor supply, the size of the labor force, is expected to be only 0.3% per year for the next 30 years, well below what it's been historically. Part of that relates to a huge wave of retirements. In 1957, more births occurred than any year that century. Why do I mention that? Because it was 65 years ago, and the relevance there is, of course, that means there's a big wave of retirements this year, the biggest ever, and it lasts till the last baby boomer, and I'm part of that cohort, born in 1964, turns 65 in 2029. So there will be a difficulty in seeing that labor force grow unless there's some other efforts made on immigration and pulling those who are on the sidelines back into the labor force. And so that could lead to somewhat higher wage growth, somewhat higher inflation, therefore somewhat higher real interest rates. But we think interest rates, and this is my final minute of comments, a minute or two max, we think interest rates have already repriced for what lies ahead in terms of the inflation outlook and the growth story, especially with growth expected to slow. But in thinking about it, there's three components of a bond yield. And this is, you simply add them together, back of envelope sort of way. Number one, it's how high should the Fed's policy rate, Federal Reserve's policy rate, be compared to the inflation rate? Pimco view tends to be 0 to 1 point over the inflation rate. I'll use 0 to 0.5 on that, various reasons why, but 0 to 0.5, it's been below 0, so 0 to 0.5 seems conservative and appropriate for now. It could be higher short term, but in the medium to long term, 0 to 0.5 seems to make some sense. Secondly, add to that the inflation expectation. We said around 2.5. So we've got 2.5 to 3 as a fair value range for the US 10-year. Then one final component, what they call the term premium. What does a bond investor want for the risk it takes to move out along the yield curve, let's say from a 2-year to a 5-year or to a 10-year? There isn't much. Yield curve is flat. Yields are almost identical across the yield curve. So there's not much there, but we'd say it's likely to drift higher, in part because the Federal Reserve won't be purchasing securities anymore. So that figure probably will be 0 to 0.5 as well. So we've got two figures at 0 to 2.5, and a 2.5 figure, which gives us a range outside of recessions of 2.5, 3.5, with some upside potential where we could say it could go a little higher. But for investors, with the aggregation of securities, and this is the Bloomberg aggregate, now at 3.6%, and this is a compilation of yields based on market cap of treasuries, mortgages, corporates, and other securities. 3.6%, and that's a good yield to us. We think it's a reasonably good, attractive yield, especially relative to potential volatility. And so therefore, as a diversifier, we think fixed income has a good place right now, especially, and as my final comment, especially since the correlation between stocks and bonds is going back to what's traditional. As yields ran up from 1.5 to 2, 2 to 2.5, it didn't seem to affect any market. And so the yields are simply correcting to adjust for the expectation for the Fed to boost its policy rate toward 3%. But as yields moved up, it decided to cause cracks in the stock market, cracks in the credit market. And that enabled the treasury market to stabilize. So a self-stabilizing aspect of the move in yields is now in place that wasn't before, partly because the treasury yields had to go higher, so to speak, because of the expectation for a higher Fed funds rate. And so now we have this new element that as yields rise higher from here, if they do, will limit how high they go, meaning if the 10-year yield moves from today's 3% to 3.25%, it probably would have a negative impact on the stock market, the credit market, and then hence improve the outlook for the treasury market. And so there may be a little bit of a stair-step pattern there, but more likely a self-stabilizing aspect of the rise in bond yields has been reintroduced, which is to say the correlations are improved, which should increase the desire for an investor to have the diversifying print factors of fixed income. All right, so I'm going to hand it over from there. We'll be talking more. Be happy to hear from you all later.
Great, thank you, Tony. And I think what you'll hear from us at NEPC is in some ways very similar refrain in terms of how we're thinking about the markets and kind of economic conditions. And I'm going to focus my comments on kind of really three areas. First, our thoughts on inflation and some of the unknowns, let's call it, that we see in that space. How we think about market regimes and potentially moving to a different type of regime or a different experience that we've had over the last 10 years. And then we'll wrap up with some thoughts on just our outlook for portfolios, kind of some strategic asset allocation thoughts to keep in the back of your minds as markets evolve through this summer. Similarly to Tony and what Pimco expressed, kind of longer term, we're not don't have too much concern about inflation. So our kind of strategic kind of 10-year outlook, our view of inflation is somewhere between 2.5 to 2.75, which is above kind of where the Fed would like it to be, but it's kind of where we've landed based on some of the demographic conditions, kind of other areas that we see influencing longer term inflation rates. I'd say where we're focused on today is really what's the path of inflation for the next 2 years. I think the one thing that the last 2 years of the pandemic has taught us is to kind of be prepared for the unknown and be prepared to be surprised in some ways. But we look at what are some of the main drivers of inflation that we've seen. First and foremost, it's been supply chains. There's been a huge amount of stress in supply chains. Near term today, hopefully it's starting to ease, but some of the lockdowns we've seen in China related to COVID will certainly have an impact coming into the summer. But also, up to, let's say this quarter, it's really been outsized demand for goods. We've all been kind of sitting at home, buying a lot of kind of physical things. We can't experience kind of the service sector like we historically would. And, to Tony's comments of, some of the recent data points, whether it be Target or other retailers, there seems to be some softening in that goods demand pressure, which should be, a little bit of a headwind, hopefully slow inflation down that we've seen. And the other, point I think is a key piece is what are we seeing in energy markets? And that has always been volatile. And I think if anything is probably even more volatile than we've experienced over the last decade. And there's really two main points to it. Energy historically is very cyclical. So as the economy weakens, energy prices should come down as demand is lower. That said, we've had, a level of CapEx and investments change quite a bit. Some of that is, regarding ESG concerns. Some of that's a push to a more green economy. Some of that has just been, financial conditions for energy companies, that there is a level of investment that frankly doesn't meet future demand. So the potential for, oil or natural gas, what it may be, to move higher is certainly there. And then you add on the pressures related to sanctions on Russia. There's very little redundancy, let's call it, in energy markets. And I think one of the things that we've cautioned ourselves to think about, and it's a little hyperbolic and dramatic, but 2 years ago we saw oil prices move to negative price, and marginal swings in demand can influence the price of oil very dramatically. We're kind of preparing ourselves. What is the point with which oil could go up? What does the economy look like? What do markets look like if oil reached $200 a barrel? That's not our base case, and hopefully certainly don't want that to transpire. But what kind of dislocation could that cause if we saw conditions of that size? But thankfully, that at certain points that tends to become countercyclical as well. That starts to kind of change the demand structure for a lot of the energy markets. Third piece, that probably the most important and most difficult to predict, frankly, is thinking about labor markets. Wages continue to rise across the board. I think anybody that's running a small business, or anecdotally talking with all sorts of different industries and sectors, wage pressures continue to grow, and there's a bit of almost an unbalanced market as we see kind of labor markets maybe heal from the pandemic. And we also potentially have this pressure, as Tony mentioned, regarding, is there an imbalance? If you think basic supply and demand economics, is there an imbalance in terms of supply of labor versus the demand for labor? And we're seeing that a high level of demand really start to change the wage structures across the labor market. And I think the key question then becomes, is this a short-term path that matches the economy being in a fairly robust growth profile, or is it starting to become ingrained in terms of people's inflation expectations? And I think if you ask the Fed what are they most worried about, that would really be inflation expectations really start to harden people's minds up well above kind of where their targets would be. And I think this fits into kind of how we think about where is inflation likely to be 2023, 2024. I think in many ways the hope is it starts to move lower, and hopefully move lower fairly rapidly, I think is the hope for many of the folks on the Fed. But I think one of the risks that we always have to think about is, what does the market look like? What do financial conditions look like if we don't see inflation slowing to the rate that we would like it to see? And I think this gets back to, how should we be thinking about interest rates and frankly market regimes? Tony mentioned this of what's the neutral rate that the Fed needs to set in terms of Fed funds to either keep inflation balanced, and do they need to go above that neutral rate, maybe it's closer to 3%, to start creating some pressures to bring inflation lower. And so I think one of the big kind of question marks that's an unknown is, where is that neutral rate? Is it kind of what the Fed has said, and hopefully somewhere in that kind of low 2%, 2.5% level, in which case taking Fed funds to 3% should cause inflation to come down. It's a countercyclical response, should cause unemployment to rise a bit, and really a lot of things to kind of take the pressure out of the economic system. But if that neutral rate is higher, I think that is some of the quote tail risks that aren't being discounted by the market in terms of should we see persistent levels of inflation, the Fed will have to reassess. And then it's a question mark of, will they execute to really limit inflation pressures and start to really limit or contract the economy? I think a lot of people have confidence they will do that, but I think that's always a risk. Will that be an environment that we see? And I think this speaks to some of how we think about investment regimes. The last, let's call it 10 plus years post-financial crisis, we've been in a low inflation, low rate world. So many of the deflationary pressures post-financial crisis, really, lend themselves to pushing far out on the risk spectrum, growth companies where you're discounting future earnings at a very low discount rate. You have a long tail of earnings far out, or kind of free cash flow far out. to value a company. So everything from, we've seen large cap growth companies in the US to the venture space, really benefited from, this incentivized risk taking. As interest rates rise, and do they rise, beyond here, or do they stay kind of current levels, really kind of will dictate what kind of regime do we move into. And I think that's a really important question that, frankly, it's hard to predict. I think there's very little evidence that folks have accuracy in predicting investment regimes. And if you ask someone in the early 80s, would they think in 20 years time interest rates would be close to zero? They would certainly say that seems almost impossible. And so thinking about how portfolios should be positioned in these different type of regimes is a really important piece for us, and really speaks to thinking about diversification. And just a couple of simple examples of that. If we have an environment where, let's say interest rates stay where they are currently, our fair value view of the 10-year treasury is close to 3% over a 5+ year time horizon. And, that says that, duration belongs in your portfolio. Having some safe haven, having some liquidity in the portfolio is a really important component to diversification. But then we start thinking about, as interest rates change, and as interest rates have risen, frankly, this year, that changes how equity markets and risk assets respond. And, I think as we kind of look ahead for the next several years, I think it's a fair assessment to say the next 2 years will be very different than let's say the roaring growth we saw in equities over the last 10 years. But then the question is, where is their best place to take risk? Is it areas in credit markets? Is it areas in equity markets? Is it private markets? And I think, frankly, as we look at the market today, there's a high degree of uncertainty. And we think of ourselves as kind of sitting at this crossroads where, do we go to a period like we've saw in the last 10 years ago? Or do we move into a path where inflation is maybe a little entrenched, a little above average of what we think it should be? Interest rates obviously would have to be higher in that market environment. Or do we move into kind of what's almost a very normal cycle? If we're in a kind of a late cycle market environment, interest rates rise, that historically kicks off a recession, and the cycle resets. And that is almost a normal operation of how we'd expect things to be. And I think we're really at this transition point where it's really hard to predict where we're going. And so in some ways, we're valuing quite a bit liquidity. We are valuing, having the right level of kind of defensive assets in your portfolio that fits your objectives. And there's certain areas that we can, target more to be a little more offensive. We prefer value equities, which is historically something we haven't really been entertaining too much. And then in some ways, just with that uncertainty, we're happy to have certain assets kind of build up a little bit of a dry powder, if you will. So some areas of the investment grade market, especially kind of short-term investment grade corporates, are areas that we've gotten more comfortable with as interest rates have risen, and happy to earn kind of 3.5, 3.75 in terms of yields until we get a better sense of where markets are going. And I think the last two things to kind of leave you with before we kick it off to Q&A is really kind of two points. One is, what level of kind of scale and repricing could we see from the Fed if they continue to tighten? I think the interest rate movements we've seen, for the first half of the year, in some ways been very appropriate for the financial conditions we've seen. And equity markets have almost responded very rationally in some ways. We're down, 15%, let's say, but, the 10-year treasury is up quite a bit. And that makes sense that we would have this sort of repricing that we've seen in equity markets. But should we see, the balance sheet, be tapered much more aggressively? Should we see changes in, how hard the Fed may need to tighten in terms of interest rates? I think that's kind of the key question going forward. I think the hope very much is we've kind of, fully discounted the right level of tightening, and we're just going to execute it over the next, let's call it 9 months. But if conditions change, there's an aspect to be prepared for, quite a bit more volatility than we've seen. I think the second piece is a little bit of a, investment behavior, question. for many folks, the last 10 years, last 15 years, we've been conditioned behaviorally for what to expect from markets. When there's a stress point in the markets, where there's a liquidity tightening, a little bit of deleveraging, spreads blow out, we've kind of relied on the Fed to step in. And I think over the next year, should we see any sort of stress in the markets, we may not be able to rely on the Fed. So how we think about rebalancing, how do we think about buying on the dip, when markets sell off, just how we've wired our brains to think how the markets may operate, probably will need some time to readjust to this new market environment of interest rates being relatively higher. It's a little bit funny to say interest rates at 3% is high, but I think relative to where we've been, it is certainly a bigger difference. And I think we just need to kind of prime ourselves in our decision making as investors for what we could expect over the next couple of years. So with that, we wanted to make sure we left plenty of time for folks' questions. So Tony and John and Dan are going to jump on and fire away.
So Phil, Tony, thank you for these thoughts. I think clearly there's something that's certain, and that there's a lot of uncertainty in the marketplace right now. So one question that's probably on everybody's mind, but the question that we're going to kick off with is the probability of a recession over the next 12 months. But in addition to that, should there be a recession because of restrictive policies from the Fed, what is likely to happen to rates? A number of market players seem to think that with lower GDP growth rates or technical recession, rates should go down. But what if inflation is actually sticky? What if we see a recession with higher rates? So we'd love to get your thoughts on that question. Tony, should we start with you? Tony, you're on mute. I think we still can't hear you, Tony.
Brittany, is Tony on mute?
Yes, she's been unmuted. All right, great, thanks. Great question. Something we're thinking about a lot these days because, how do we approach a scenario where the inflation rate stays high, even as the economy slows? In the past, that might lead to a flattening of the yield curve, when we have seen that the past year. But how much more flattening would there be? Would longer rates, in fact, start to decline in anticipation of the Federal Reserve lowering its policy rate? As Phil suggested, that so-called Fed put may not be as present in the next downturn as it has been in past downturns, because the Federal Reserve is keenly focused on the high inflation rate. And so it may be that the interest rate level stays higher than we're accustomed to. It won't fall as rapidly, and it certainly wouldn't fall to 0% like before. And what investor, given the damage that's been seen globally in the interest rate front, would be willing to hold a negative yielding bond against? So imagine a German 10-year Bund, the government bond, which yielded minus 50 basis points. Today's over 1%. Imagine that yield, if it fell back there, how investors would treat it. They probably would say, no thanks. And so that would limit how far yields go down, because there would be this fear that it could ignite what we recently saw. So there'll be, John, in other words, somewhat of a recency bias to how investors treat yields going forward. And so while we would expect a decline in yields, we would expect that there may be limitations because of the concept that Phil gave us, which is regarding the Fed and the absence of a Fed put that we might expect. And of course, because investors have been scared by the recent move in bond yields and wouldn't want to invest at low yields wholeheartedly, even as they decide to increase their fixed income allocations because of reduction in risk attitudes.
And Brittany, unmute, please.
Yeah, and just as maybe a quick aside to that, to kind of jump on to Tony's comments, I think one of the interesting aspects is, as we've seen a little bit of fear just in terms of folks holding duration and holding interest rate sensitive assets, to what extent, not to be too tactical with it, there is a certain point to which, owning more interest rate sensitive assets will start to make sense, above and beyond, your, let's call it strategic asset allocation targets. And I think one of the interesting things that's always present, especially for buyers of municipal bonds, is typically there tends to be more dramatic flows in and out of that space. And so as that fear premium rises, thinking about even slightly longer duration assets may make sense in that space for folks' portfolio.
John, can hear you.
Hi, can anyone hear me?
Yes,
Yep.
we can hear. Sure.
Okay,
I was
Great.
just saying that this is going to be probably one of the key questions to watch over the next 12 months. So thank you for sharing your thoughts. I'll hand it over to Dan.
Great. Thanks, John. We've talked a lot on this call about the Fed's desire to engineer a soft landing for the economy. We've got one question asking about, does a soft landing for the economy translate into a soft landing for markets? And I'll take that.
Yeah, I think when you look at kind of what the market's discounted, I think the market's discounting roughly Fed funds at some point gets to, a 3 percentage point level, maybe early next year. And that's fully priced into markets today. Equities have repriced, that discount rate's higher. That's very much kind of responded to what we've seen. But I think one of the questions is, as we transition to this soft landing, let's call it, how does kind of corporate America, how do issuers adjust slightly higher yields? Conditions will weaken, financial conditions will be a little bit tighter. Growth will be a little, lower than we've seen in the past. And I think one of the pieces that we'll find is, where do the weak companies exist? Where do the weak entities exist as interest rates move higher? And I think there's been a concern, really since the financial crisis, of how do the weakness in financial markets and stress in the financial markets translate to kind of, what you'll see in a headline is kind of the real economy, or kind of the Main Street economy. And I think that's going to be a really critical point for monetary policy to manage. And maybe it comes less through the management of Fed funds and is more of relative to, what's the size of the balance sheet? We're over $8 trillion in its size. What's the terminal point for the balance sheet that helps keep a healthy balance between managing inflation, but also not creating a deleveraging spiral in the market that I think all of us are probably primed to be a little bit terrified from after 08 and 09.
Thanks for that. I think one concept to think about in terms of whether markets would be happy with growth reaching the elusive soft landing. And by the way, soft landing would be growth between 0 and 1.8%. Growth potential is 1.8. Anything above it can bring inflation pressure. Anything below it can bring the characteristics of recession without seeing an outright recession. Of course, an outright recession is a decrease in employment and output. In a growth recession, where the growth rate declines but still positive, simply a softening in labor demand, softening in output. These are things that would be welcome today because there's an excess of those things, and that's causing inflation. But what would be good for markets, and I think Phil alluded to it, is the sense that we don't really know. There's a lot of uncertainty about the future. Uncertainty is another way of saying, in terms of equity market jargon, that the equity risk premium today is probably higher than it would otherwise be if not for the considerable uncertainty. So to the extent that market participants decide that the economy has reached a so-called elusive soft landing, they may then decide they don't need the extra premium for the tail risks of that could occur from the Fed having to raise rates even more, and from other factors that have been causing harm to markets of late. So it'll probably be seen quite favorably.
Got another question that just came in. Given all the uncertainty and the cloudy outlook that we see, how do you see investors' portfolios and asset allocations potentially changing in this environment?
Yeah, so I mean, I think a couple points for, in many ways, the clients we work with, these are kind of, asset pools that, are really meant to be, long tenured in kind of, investment goals and kind of investment views. And so don't want to be too tactical with how we're thinking about things. But I do think, as we think about conditions today, I think we are kind of cautious and cautioning folks, try not to make too big of changes. There is a fair amount of uncertainty. There are a lot of question marks, let's say, in terms of earnings profile for equities, path of interest rates, inflation. So we don't be rash in our decision making. But I think a couple things to think about is, thinking about a couple what ifs and how you might respond to those. First and foremost, if we see interest rates rise a bit, if we see interest rates rise, let's say another 100 basis points, that's likely to impact equity markets. Then it starts to raise the question of, we think fair value equity versus bonds over the last 15 years has been heavily tilted towards, the equity kind of risk premium, let's say. But when we look back in, let's call it the 90s and even the 2000s, kind of post-dot-com period, there was a very much incentivized structure to have a good balance between fixed income and equities. So we think about, should we see higher interest rates, thinking about higher targets to, fixed income, to credit, to muni bonds may be appropriate. And it's a little boring at times. It's not the exciting, look at more venture capital type idea, but there is an aspect that we could see a little bit of that repricing, and think about that being one of the action items to take down the line. I think the other piece that's really near term is, the hope is inflationary pressures start to lessen. But I think through the course of the summer, we're probably going to see, from a headline CPI level, probably some more volatile prints, whether it's coming from the energy segment or whatever it may be. And we've been really encouraging folks not to treat inflation-sensitive exposure too tactically. And what we mean by that is, inflation sensitivity is a reflection of your goals and objectives. And if you have a level of spending or a level of outflows from the portfolio that are really sensitive to the inflation rate, then there probably should be more inflation sensitivity in your portfolio. But if there isn't, thinking about just the basics of equities and bonds and term premiums and risk premiums is really kind of the best way to be diversifying the portfolio, as to versus trying to tactically time, where energy markets might go or the path of break evens, let's say. And so, it's a little bit of a cautionary statement, I think, to kind of, even if inflation maybe is running above expectations, to still be kind of, I think, pragmatic about where you're building exposure to the portfolio. Tony, you're still on mute, I think. Still there, Tony?
Especially your last points, which relate to market timing. Market timing is a directional strategy. There's so much more to do than attempt to do what's quite difficult and pinpoint, for example, where the 10-year yield will go. I think of a fixed income book that exceeds a book I wrote of 1,200 pages, book by Frank Fabozzi, a 1,500-page book, handbook of fixed income. If there were a section devoted to what to do if interest rates rise or fall, if you expect that, in terms of duration, it would be half a page. So that means there's 1,499 and a half other pages in terms of what else to do. in markets, and the diversification principle is foremost. And we would suggest, especially with yields higher today, especially and in the context of the low volatility of the assets historically, market timing, the diversification benefits of fixed income is probably not the best idea, and we attempt to avoid that and would rather source returns elsewhere. There are several other things, I'll rattle these off quick, that we think investors will be doing now, and Phil alluded to these ideas. Moving up in quality, it is late stage of the economic cycle. The 3.6% unemployment rate tells us that. It's remarkable 2 years later after the jobs rate had reached over 14%, but this is where we are. It has been a fast-moving cycle, so you've got to position in that way for the idea that it could end, but we're not projecting that in the next couple of years. It's possible, given how late in the cycle we are. And so you move up in quality, have a little more cash, more flexibility, more agility. Consider short-term assets. If you're worried about duration, the yields are not that different from a longer-term asset. Lots of good things to do there. So up in quality. The third thing is to think along the lines of risk factors, because diversifying between stocks and bonds doesn't necessarily give you diversification. You've got to think of the risk factors. So what do I mean? In some equities, there's interest rate risk. In some bonds, there's equity risk. You have to think along those lines. And it's something brand new, and Pimco was discussing this in its 5-year outlook recently at its secular forum, that the diversification now might mean thinking along the lines of looking through the world from a national security lens. It was only recently that we had to decide that certain assets could become impaired, affected by changes in the chairs on the deck of the political ship, if you will. And so lots has happened that could cause change to portfolios in terms of performance. Think of the changes in the performance of sectors like the energy sector, et cetera. Lots can happen related to this new geopolitical angle and big seismic changes in the political, economic, and monetary order, big things. Finally, investors these days are seeking to extract, where they can, illiquidity and complexity premiums. They move to the private markets for that, and there are lots of good things to do there. One need be cautious, though, but it does make sense for investors to consider diversification into certain assets there, where there are pretty good levels relative to the public markets of complexity and illiquidity premiums, and those markets, while potentially riskier, they're not prone to seeing overvaluation from vast amounts of money flowing into them, as the public markets have, and you saw that last year, for example.
I had one question come in a little bit more specific. How might quantitative tightening, the wind down of the Fed's balance sheet, play into these matters, given that the magnitude of the balance sheet and the duration that it would take to unwind it fully? How might that play into these matters?
I can quickly answer, Phil, and I'll turn it over to you. Just one important way to think about quantitative tightening. As Phil said, the markets are priced for a 3% funds rate. But there's something else with the QT, quantitative tightening, that we should add to the equation to figure out how much tightening is priced in. Quantitative tightening, according to the Fed and Chair Powell, $1 trillion of balance sheet reduction at the Fed, and its balance sheet today is $9 trillion. $1 trillion occurring over the next year, which is what's anticipated, is the equivalent of a 1/4 point change in the Fed funds rate, according to the Fed. Lots of different studies about this, but we really don't know. There's a high degree of uncertainty. $3 trillion of balance sheet reduction is what's expected. So in other words, add in that, the equivalence, 3/4 point to the 3 points of Fed funds rate change that's expected, and then add in the possibility that the change in the impact of the changes in the balance sheet could be nonlinear, meaning the 2nd trillion, the 3rd trillion could have more impact on markets than the 1st trillion of balance sheet reduction. And you pretty much have a 4% funds rate in equivalence priced in. Now, how does that compared to history, since the late 1980s, the average change in the Fed's policy rate during a tightening cycle is a little over 3 points. So the markets are priced for about 4 points of monetary tightening. Is it enough? No one knows. Phil said that as well. We just don't know. But it is significant relative to history, and perhaps a little more is needed. But it's great to know that lots is already priced in, and that should be a mitigating influence in terms of risk for investors in the time ahead.
Yeah, and I don't have much to add to that. I think just the interesting aspect is, the folks in the central bank are humans also with kind of their own behavioral expectations. And, we've seen over the last, 10 plus years, every kind of path to kind of taper or tighten the balance sheet, we have seen a little bit of market disruption. So they're very cautious and hopefully pragmatic about what tightening looks like. And, that could be completely appropriate, but also, there's an aspect of, with this uncertainty, does that caution kind of inform them maybe moving a little too little? And so there's very much a what's the right point of, is the bowl of oatmeal too hot, too cold, just right? We don't know. And this is really going to be a monetary experiment that we won't see the results for probably for a couple of years, that really kind of dictate the outcomes of it. And I think we can say at least it will be interesting. Yeah.
So, last question of the day that came in. In the world of potential extreme scenarios, which do you think is more likely on the 10-year? 1% or 5%?
Yeah. I wish I could say both. Is it in some ways,
So maybe Phil, to add to that, which one do we see first if we were to see both? Is it 1 or is it 5?
I think it's binary. We will only see one of those if conditions get bad, because you can paint a picture where inflation really comes down very fast. The recession, a recession comes on, and you see a big pivot from the Fed where they say, hey, you know what? We're not going to go 3%. We're not going to do any more cuts after this September because of some messiness and for whatever may occur, kind of, economic stress. And on the other side of it, wage pressures continue to expand, behavior expectations in terms of inflation really kind of solidify. And right now we're at a real rate for let's say 10-year Treasury, a little under 50. So 150 basis point 10-year real rate is not it's not unusual from if you look 20 years ago. So there's a path to get to both, which really makes me a terrible gambler, but I'd rather be the house and set the lines at 50-50 on that, because I think it speaks to the uncertainty. And I think how, investors maybe are feeling a little frozen at the moment.
Yeah,
I think we've got.
John, go ahead.
I'm sorry. I was just going to say we have one last question. One last question.
Answer. Go ahead.
No, I'm sorry. Go ahead, John. I'd like to hear from you, and then I've got one last question.
So we would agree. John made it difficult for us putting the 4-5 handle there. 4 would have made it a lot easier. So it seems possible to get to 4, much more difficult to get to 5. So the story is probably binary.
Thanks, Tony. One that just came in, and we know that, we know how punishing inflation can be, and it hurts those the most that need it the least. And so as we wind this down, if you had one single biggest worry in terms of inflation and current Fed policy, what would be that biggest worry?
I can go quickly. I would say the biggest worry would be, but this would not be the baseline, that the Federal Reserve backs off on its inflation fight. What we want from the Fed is to be the cop on the beat, so to speak, rather than have the bond market and do what it used to do when the expression bond market vigilantes was pretty commonplace. And so a Federal Reserve that is tough and provides tough love, which is what you're seeing, because you're seeing the markets take that spoonful of medicine in a very harsh way of late. Markets will prefer that in the long run. This is what has happened throughout history, where the Federal Reserve is able to control inflation, and markets ultimately cheer it.
Yeah, I 100% agree. I think, we can look at all the historical analogs that, unanchored inflation or above average inflation is just a tax on everyone's portfolios. And the Fed, and all things indicate they're of this view, will need to act to meet the conditions. And I think if they don't, that opens up a very different, box of risks that hopefully we don't have to engage with.
Great. Well, I see that we're right up against our 1 hour time slot, so I think we can conclude today's call. I'd like to thank my colleague, Phil Nelson, both Tony Crescenzi and John Harari from Pimco, but mostly we want to thank you, the clients and guests from both NEPC and Pimco. We hope you found this useful as we navigate this new economic environment. Thank you again, and have a great rest of your week.
Thanks, everyone.